Hello, everyone, and welcome to day one of RevEx Fest, the Revenue Excellence Festival for Modern Sales Pros. We're so excited to have you here, and we're super excited to dive into the full day of events that we have lined up as well as for the rest of the week. But before we begin, I'm going to say a few words about Modern Sales Pros. So today's event and the whole week, the whole summit is brought to you by the team at Modern Sales Pros. Hi, everyone. My name is Angelica. I am one of the community event managers at MSP. And for those of you who are not familiar, Modern Sales Pros is the world's largest and highest quality community for those in sales management, sales enablement, sales leadership, revenue operations, aka our modern sales pros. And our mission is to create an environment for our members to answer the toughest revenue questions out there. So if you're not a member yet, you'll be invited to join right after Summit. And our summit, it won't be made possible without these amazing sponsors that you see on the slide. So big thanks to all these sponsors, and be sure to check out the sponsor tab located at the top tab located right next to the agenda. And speaking of the agenda, don't forget to check out the full list of all of our events coming up today, along with tomorrow and Thursday. Now for the agenda for today's session, I'm going to do some quick housekeeping notes. I'm going to pass it off to our speakers to do introductions, and then they're going to go dive into the discussion prompts, and then I'll come back for closing remarks. So first and foremost, familiarize yourself with Goldcast. Definitely check out the sponsor tab and the agenda tab and use the chat function. We love interaction. We love to know where everyone is calling in from. So definitely add in what city or state or country you're calling in from and make some friends. We're here to have fun. Definitely ask some questions. So definitely use the Q&A function located at the top right-hand corner. Now, I'm pleased to announce and introduce the craft of bottom-up, modern SaaS, GTM, and investing with the father of bottom-up. I'm going to pass it off to Pete Kazandri to introduce our awesome guest speaker here today to kick things off for the RevEx Fest. Pete, take it away.
Thank you very much, Angelica. Hey, everyone. My name is Pete Kazanji. I'm super excited to have David Sachs here with us for the RevEx Summit, the godfather of bottom up SaaS, here live and direct. Couple of introductions before we kind of get into some of the topics that we're going to cover today. For folks who don't know me, I'm Pete Kazanji. I'm one of the founders of Atrium. Atrium makes data-driven sales management software that helps sales managers, leaders, and reps use metrics to improve performance. Prior to Atrium, I started a recruiting software company called Talentbin that was acquired by Monster Worldwide in 2014. And subsequent to that, wrote a book on startup sales called Founding Sales. So think a little bit about sales excellence, et cetera, et cetera. When I was starting out, though, bottom-up sales wasn't really a thing, although I suppose it was after Yammer. So I suppose technically it was. Super excited to have David here today. David, you want to go ahead and share with folks who have been maybe living under a rock a little bit about yourself and your background?
Sure. Well, good to be with you. So today I'm the founder and general partner of a venture capital firm called Craft Ventures, and we invest primarily in SaaS companies. We also do some marketplaces, but it's primarily B2B SaaS. And specifically, we love SaaS companies that are able to use a bottom-up market to basically reach customers. And before this, I guess the experience that's most relevant is I was the founder CEO of a company called Yammer, which we started way back in 2008, which was one of the first of these bottom-up SaaS companies. And we sold the company to Microsoft in 2012 for a unicorn outcome. So yeah, that's it in a nutshell.
Not a bad little thing. Actually, I mean, before we get into some of the bottom-up stuff and other topics, how was the transition? Because I mean, you were one of the early executives at PayPal, which is, I mean, both a consumer fintech application, but also like a marketplace in some capacity. How did that transition go from that to like Yammer? It's a little different, right?
Yeah, and I think that really the way that this whole idea of bottom up came about was me taking growth tactics, basically consumer tactics I had learned at PayPal, and
Right.
applying them to enterprise software. No one had really done that before. So you're right. I was part of the you go way back to 1999 to 2002, that sort of famous PayPal Mafia founding period. I was the COO and head of product at the company. It was very much a consumer product, and we learned all these like growth hacks. Basically, we pioneered a lot of viral tactics. And when I started Yammer, part of the reason why we use all of these viral tactics is we didn't know better. I actually had never done sales before. I didn't even know what SaaS was. I didn't really understand all the things that you're supposed to do in
Right.
enterprise sales. My view, somewhat naively, was I don't need a sales team. I can just go viral. We're going to design, we knew we were designing a product for enterprises. We were taking the concept of social networking and turning it into a collaboration tool that would improve productivity inside enterprises. But
Right.
I didn't think we needed all of this enterprise stuff. I thought we could just go viral. And so we designed the product to basically be as viral as possible. And in the process of building the company, we did get traction with that model, but we also learned that, okay, these functions exist for a reason. And we started backfilling, enterprise sales, because the bottom-up usage created a great top of funnel, but it did not, the deals were not self-closing. So we realized, wait a second, we've got great activity, the virality works, but companies don't just pull out their credit cards and buy an enterprise-wide license with a credit card. They got to talk to somebody. So that's when we basically created a sales team. And then, well, the sales team needs to be supported. So we created a enterprise marketing team that would create competitive battle cards and help equip the sales team. So so we ended up like reverse engineering what a enterprise software company would look like. Nonetheless, it didn't mean that bottom up failed. It actually turbocharged the growth.
Right.
And so Yammer was sort of this interesting hybrid of consumer and enterprise tactics.
Yeah,
And
it's like a happy innovation, like accidental innovation, happy accident, what have you, where in this situation, like when all you have is a hammer, everything kind of looks like a nail. But it turned out that, and I think a lot of bottom up, well, not SaaS, but like bottom up, like sales behavior has existed historically, certainly not in business tools. That like open source software was one of the first places where this showed up in dev tools and what have you, but not like architected on purpose. It was more like the software is a piece of content marketing that would like be hosted on a website and people would download it and what have you. Not architected for like business users, certainly not architected to use like, to travel along communication rails or like email rails or whatever to drive virality. But that's so fascinating to hear that, like, it was coming from a consumer background where like obviously a lot of growth hack kind of like behaviors happening in PayPal land, and then applying it there, and then poof, a realization like, actually, if we're going to get somebody to pay us 20 grand or 50 grand or like 200 grand or whatever, like there's probably going to be human involved. That's
right.
That's fantastic. So I guess like at this point though, now this is just like a very, very popular motion, right? Like whether you call it bottom up or like, product led growth or what have you. Why has this been so revolutionary for as like a highly popular way of going to market? Like in the case of Yammer, it was like, hey, we knew how to do this thing, so we just did this thing. Now people are making an intentional choice to go about this. What's driving that?
Well, I think what's going on is that you had this artificial wall that existed between consumer and enterprise. And, back in the early 2000s, when I was doing PayPal, we did consumer software in a very iterative way. It was designed to be viral. You went directly after the end user. You didn't have to go through gatekeepers or decision makers. And you did a lot of A/B testing. There was just a lot of experimentation. You'd ship constantly. And then in the world of enterprise software, even happening at the same time, it was just very different. It was all sales led, top down through, gatekeepers at the enterprise. You would design
whoever
CIO. You would be designing to check boxes for them and what they said their needs were. RFPs, not what end users said they wanted. you wouldn't even, there wouldn't be so much iterative development or experimentation, because you do stuff like burn a new version of the product onto a disk and ship it, or the equivalent of that, once a year,
God,
right? So
right.
so
If that.
if that, right? So just enterprise software was so different than consumer software in every way. And around the time we started doing Yammer, we started questioning why. Like we
Yeah.
had a very, as consumer founders who were attacking the enterprise, we had a strong belief that, look, A/B testing is a good thing, experimentation is a good thing, rapid release of the products is a good thing. Having
Right.
one version of the product that's up to date because you're multi-tenant, your multi-tenant SaaS or cloud-based is better than being on-prem single tenant. So we had all these like strongly held views based on our consumer experience. And I think that what's basically happened is the walls between consumer and enterprise software development have broken down so that the best practices are available to both. And so that's like one major theme, is that this artificial wall has come down. Now, I know that there are enterprise software companies that still want to do, on-prem, and that there's new technologies like Docker that make it more feasible, but
and there's certain use cases that really resist kind
right.
of the atomization of like the use case, like kind of hard to have a bottom-up workday or what have you, right?
Right.
But yeah.
So it's not, it's not the case that everybody has to do things this way, but by and large, people have moved around to realizing that, multi-tenant cloud is generally going to be the best approach. And with that will come, a more rapid release cycle. And with it comes sort of this idea of consumerization, of building for the end user,
Yeah.
and as opposed to just the gatekeeper. Now, specifically, I think when it comes to bottom up, I mean, really what bottom up is referring to is, in contrast to top down, is, again, it's who is your entry point into
Yeah.
the enterprise going to be. And bottom up is any employee can be the entry point, whereas top
Yeah.
down, again, you're going through IT, and that IT person really doesn't have the same incentive to, I mean, the CIO's incentive is generally not to have a breach that's going to lose a bunch of sensitive data and get them fired, whereas the employee just wants tools they're going to make them more productive. And
Yeah.
then you can have like a line of business owner who's sort of in the middle, who's sort of halfway between that. So, this bottom up approach is really going directly after the end user and turning them into the entry point of how your software gets into the enterprise. And hopefully that end user is spreading it virally to their coworkers. That's what bottom up means, as opposed to, again, going top down. And, same type of idea. Sometimes people call this product led growth. Again, in contrast to sales led growth, where again, the question is, what is the first touch point that the software vendor is having with that prospect? Is the product the first touch point, or is a salesperson's call the first touch point? It's much more efficient if employees at that target customer can just start using the software, and it'll save you a whole bunch of demos. It'll save you a whole bunch of conversations about ROI if they've already used your product and they like it.
Yeah, and you can parallelize. I mean, I almost think it's funny that there's the consumerization of IT, which is like, hey, we all use like iPhones and like MacBook Airs, and so like we're not going to tolerate like broken ass like shitty enterprise software, right? There's like that piece of it, but then what you're describing is like kind of a consumerization of go to market as well. Like, why not use, like, I know that you guys are Craft is an investor in ClickUp. I can't go anywhere without seeing like a ClickUp sign, and I know that it's going to save me a couple hours a week, obviously guaranteed, right? Because I've had this many. And of course, like the next time I think about like handling some sort of case, related to some workflow, I'll be like, hey, maybe I'll give ClickUp a try, right? And so like obviously that's a very consumery. There's like a consumery kind of like piece to that. The other thing that kind of fascinates me is there's Ronald Coase wrote the seminal like econ paper, like the theory of the firm, right? Like, firms grow because they want to have internal resources internally, like, a designer or what have you, where the transaction cost is too high, right? For that thing to be outside of the organization. And if you think about like the transaction cost for adopting new technology, usually it's going to be gated by somewhat, like it's going to be gated by like the scarcity of attention. Like if everything's single threaded through the CIO, and you point out the fact that the CIO also has all these kind of perverse incentives. Even if you get down to like the CMO, the VP of market, the VP of sales, whatever, again, they're like attention constrained. Whereas if now all of a sudden what you have is like all these little like microeconomic actors, like, you know, a sales, like an account executive, like use Scratchpad as an example, another craft portfolio company. If some AE is like, hey man, like I just want to go faster, like, and I don't want to waste so much of time like entering stuff to Salesforce, and then they can they can look out into the market and assess a solution. Well, this just like makes technology adoption way faster because they can go out and like have an external relationship rather than waiting for some decision maker internally to make that determination for it. So it's almost like it like accelerates like economic churn, right? Not churn like, you know, churn out. I mean like churn like the good, like, you know, ferment, right?
Well, it's
and
it's
allows
immediate,
better adoption.
It's immediate gratification. I'm maybe one of the few people listening who knows Ronald Coase and the theory of the firm that you mentioned. But yeah, that was.
Oh, come on, everyone does.
You're going back to my law and economics days, but yeah, the basic theory there was that the lines of a firm are drawn where it becomes inefficient to contract with people, because actually working with people via contract is time consuming to set up, and it's inefficient and rigid. You don't want your coworkers to be consulting a contract every time you want to be telling them to basically collaborate or do something. So in any event, yes, you don't so the lines of the firm get drawn so you don't have to contract. And I think the analogy is apt in a similar sense here, which is if you're an employee, you're a developer, and you just need some tool, or you're a salesperson and you just want some better sales tool, you don't want to have to like sign a contract first. You don't want to have to even talk to a salesperson if you don't have to, and get a demo and go through procurement and legal and contracting. You don't have to sign like an enterprise software agreement. That's very time consuming and slow. What you want to do is just go to a website, you know, sign up for a free trial and just try using the software. And it's that immediate gratification. And that is what makes bottom-up software or product-led, whatever you want to call it, so much more attractive to employees. And, you know, the argument we were making a dozen years ago when IT was up in arms about this, it was, you know, because they felt like they were losing control, is this is actually a good thing for you, because how much shelfware have you bought? You know, how many times have you guys done how many times have you guys done an RFP because you think you know better than the sales team what tools it needs, and then you buy something they never use?
Sits there.
Why don't you let them do those free trials and see if they like it, prove out the ROI.
If it catches fire.
Yeah, exactly. And then you guys can manage it once they decide they want to contract.
Yeah. It reminds me, sorry, not to get like too geeky here, but of Friedrich Hayek's The Road to Serfdom, where you know, microeconomic actors are really helpful, right? Because they have profit motive and they like want to take actions, right? They want to, like, if you're like, and it's not just account executives who want to make more money. If you have a software engineer who wants to ship more things and he can't search his code base and he's pissed about it, and he can just like download source graph and like get up in there and like search across like his entire code base. Now he or she is like super pumped there. And so what you're doing is you're ending up devolving this like, you know, this like innovation, or like innovation, demand side innovation, to all these like little like microeconomic actors who can take, you know, who can take actions. Anyway, okay, bottom up stuff, like obviously very helpful. I think a really important thing that people have realized is that the software does not sell itself, and like you just have to be very careful about that. I think early on, Yammer figured that out. I think there are other organizations that maybe kind of took a little bit longer to figure that out. Maybe Dropbox is a good example of that, where maybe they resisted that. And I think you're getting this good like admixture of like product and like go-to-market expertise, where it's like, actually, it does have to be chocolate and peanut butter. It can't just be one together, or one only. So
that's a really important point. Just to build on that, I think that a lot of successful enterprise companies, you know, they started with at the same place we did, which is, hey, we're product founders. We have background in consumer tactics. We don't need this enterprise stuff. And they've all learned the same thing like we did, which
Yeah.
is that you still need sales. You still need these enterprise functions, because bottom up, I think what it's primarily good for is lead gen. What
Yes.
happens is that the employees come in through the top of the funnel, they start using it, maybe they do a free trial. And sometimes, depends on the company. Some companies have had a lot of success with sort of self-service plans. But
Yep.
if you want to sign a true enterprise deal, like certainly a wall-to-wall license or even a large department, they always want to talk to somebody before they will buy. And so, yeah, what we learned was bottom up is great for top of funnel. It's the most efficient way to get distribution, but in order to convert those deals, you still need salespeople.
Yeah, the kind of terse way I describe this is like never mistake your lead gen for your business. Like
Right.
it's not your business. It's your
Right.
lead gen. Like let's
Right.
Lockheed just came inbound. Great, let's have them talk to a human.
Right.
Speaking of go to market, Craft has a pretty impressive portfolio of go to market tech. There's I think a couple of folks that we mentioned already. There's Scratchpad, Sendoso, Orem is another one. Specit, Atrium is obviously
Yes.
a Craft Portco, User Gems.
Mhm.
What's the thesis behind investment in go to market tech, and where do you think that's going?
Yeah. So what happened there is we didn't really set out with a thesis of we're going to be the VC who does all the go-to-market SaaS deals, but we ended up there. And the reason is because actually we're much more metrics focused. So we started seeing a lot of these go-to-market SaaS companies actually hitting, fast growth, hitting the ARR thresholds that we like to see. And I think the reason is because when you're close to revenue, it's easier
Yep.
to prove ROI. That's what it comes down
Yep.
to. There's a reason why Salesforce is the number one SaaS company still to this day with the biggest market cap. There were other SaaS companies that started around that time that were successful, like a NetSuite. There were others, but the difference is that Salesforce was going after sales teams. The others are going after finance teams, marketing teams. And it turns out that if you're close to revenue, that is really the best place to be because it's so easy to prove value. And, look, it's great if you can prove value in terms of creating efficiency or cost cutting. But if you can show that you increase the revenue of a customer by any measurable percentage, they're going to want to buy your product. So we've ended up doing a lot of go-to-market SaaS. We like that area. And now I think we've got a little bit of like a kairetsu around it so that it's sort of feeding on itself.
True.
And founders who have a go-to-market SaaS company hopefully are seeing us as a preferred capital partner.
Oh, I mean, yeah, totally. I think that's really fascinating that sales tech will always have wind in its sails or wind at its back because it's so close to revenue. And I think actually the corollary is true. This is something I have a bunch of friends. My last software company was a recruiting software company. There's HR company. Anytime you have functions that are purchasing your solution that are viewed as a cost center, even though you might think that people talk about how humans are their most important asset and human capital is actually where revenue comes from and where the product comes from and what have you. Yeah, but it's still kind of like two layers of abstraction removed there versus just, pretty hard to argue against like buying SalesLoft or Outreach if you can say like, yeah, your SDRs are going to produce 25% or 30% more meetings.
Right.
Like,
Yeah,
shut up,
exactly.
take my money.
Well, just to one of the examples you mentioned, Orem is I think a really good case of this where it's using conversational AI to navigate the phone trees and the voicemail systems of prospects. So, instead of having the outbound sales rep or the outbound SDR spending all their time dialing and trying to figure out who to talk to and talking to receptionists, trying to get through the right person, Orem will literally do all of that work for you. Use a computer will pretend to be a human, again, conversational AI, and it won't put the sales rep on the phone until they get the right prospect on the phone with them. So it's measurable. It's like the outbound SDR can talk to 5 times as many people. if they're using Orem. So, when, and that obviously translates into more sales, more qualified leads, and so on. So, so that's just
highly leveraged SDRs.
exactly. So the ROI is very measurable when you can create that kind of lift in sales or in qualified leads. And so yeah, and people will pay a lot of money for that. So yeah,
It's so funny that you guys derived it by seeing didn't necessarily have a thesis. It's like, here's a bag of startups. We're not actually going to tell you what flavor that they are. Tell us which ones you like. You're like, well, I really like these metrics right here in this bucket.
Right.
All right, let's see who the singer is. Oh, look, it's go-to-market tech.
Yeah, I mean, it's, for the historical threshold for, a Series A, it's been around 1 million of ARR, and you want to see, 15% growth plus or minus. Great if you can see 20%, 10%, it's good. 15% starts to be very good. Any event, you're looking for those kinds of metrics, and we just start seeing a lot of companies hit those metrics that were in go-to-market SaaS. And I think it's because of this reason, which is the value is easy to show.
Yeah, and then actually, and I think if you double that up with the prior thing we were talking about bottom up, what you have is a bunch of like smart technological actors, or smart microeconomic actors who have very strong they have very strong economic incentives themselves to make themselves more effective, right? So you can imagine individuals like buying Calendly on their own, or at least adopting Calendly, or adopting Scratchpad on their own, or adopting UserGens on their own, or like buying their own seat of like Sales Nav, or at least adopting it because like anything to get an edge, they have a huge economic incentive to do that. And of course, then when they go to Uncle Bob, the CFO, with like the money in order to like run it across the entire organization, well, it's very close to revenue. So essentially, you have like a lever on a lever right there, kind of helping those guys have a tailwind. You were mentioning some SaaS metrics earlier there, and I know that so for folks who aren't familiar, David writes a blog that I think is called Bottom Up. I want to say it's a Substack. And by the way, if you guys don't listen to the All In podcast, it's pretty fun. You should do that. It's never a dull moment on there. But I think you've done some writing on SaaS metrics and kind of helping people get smarter around that. What are the kind of the most important ones that founders and sales leaders should be paying attention to right now, and what are the ways that they can get smarter on those things?
Yeah. So actually I have a blog post on Substack, which I think you can visit at sax.substack.com. And the post is literally called The SaaS Metrics That Matter. And we kind of list like
it says on the tin.
Yes, we list the metrics that are important and which ones you're paying attention to. So what I would say is during an economic boom, the only 3 metrics that matter are growth, growth, and growth. That's all that VCs look at. But when you're in a down market, which we are now, it changes, and investors start looking at growth, margins, and burn, or capital efficiency. So it's not that growth stops being important, but people also want to know that you're growing in a capital efficient way, in a margin efficient way. So, you still have growth, but you also want to know that like your CAC makes sense, that you're not burning too much money, your sales and marketing spend makes sense. We've defined a metric called burn multiple, which is how much are you spending for each dollar of net new ARR you're adding. And, we like to see that startups aren't burning more than $2 to acquire $1 new of ARR. And really, if you can get to a 1-to-1 ratio, so let's say in a given year, you burn 5 million, but you've added 5 million of ARR. I think that'll be an excellent ratio. So we pay a lot of attention to burn multiple, and then, margins start being more important. For SaaS companies, gross margins historically, you just start with great margins because you're a software company. So, but for companies that are more hybrid or have a physical world component, you really have to be careful about that. We really don't want to see gross margins ever go below, call it 50%.
And so I didn't realize that. So the burn multiple was something that's a Craft original. Is that what you were saying?
Yes, it is. Yeah, I have a blog post from a few years ago. Actually, I wrote it in 2020, And yeah, it's that was the first time
Just like,
the
but
term has ever been used.
people are like, whatever. Interest rates are like -3% right now. Get out of here with your burn multiple. Get out of here, Grandpa. That's funny. I didn't realize that
It's
because
only
everyone
about,
talks about it.
yeah, it's only about the blog post is called The Burn Multiple. It's only about 2.5 years old. I actually wrote it in Q2 of 2020 when the market took,
Well,
basically
the
swooned.
first,
Yeah,
yeah,
because of COVID, and then the Fed started printing a lot of money to get us out of that. But there was like this quarter where it looked like we were about to go into a pretty serious downturn. And so, and then everyone kind of promptly forgot all those lessons about being capital efficient. But yeah, it's been gratifying to see that, like, in board meetings now, I'll just see burn multiple reported as a standard metric.
yeah.
I'm not sure how many people know that we came up with it, but yeah, that was a craft original.
You guys need we need some more, like, we need some craft branded swag around that. Like, it is fun when you see like a product marketing coinage like out in the market. Like every time
Yeah,
I see someone talk about like founder led sales or whatever, I'm like, oh, nice.
yeah.
That's that presentation that I that has been flying around the around the web there.
Yes.
Um, what would you be your kind of, I mean, aside from your blog post on the SaaS metrics that matter and burn multiple, whatever, what are other kind of ways that that founders and sales leaders can get smarter around these things? Because they're not everybody comes from an analytical kind of like financial background in that regard.
Well, I do think that with SaaS, everything is so benchmarked, and
Mhm.
so I do think that, like, you do have to set up your dashboards. You do have to, understand your key metrics. I mean, net dollar retention is another really critical one. You gotta,
Mm.
gotta understand your cohort analysis. But the reality is there's so many tools now that you
Yeah.
don't necessarily have to do the work yourself. So for
Yep.
instance, one of the tools that we created at Craft is called SaaS Grid, and you just go to saasgrid.com, and you just put in your basic customer data, and it will spit out all the key SaaS metrics. We
Yep.
created it as a way to, I mean, we were creating all these charts internally to evaluate companies. We're like, why don't we just open source this so founders
Yeah.
can use it themselves? And I think it's like one of the best tools out there to actually like dashboard your metrics. So I do think that's important. And then there's like a whole like wealth of information on playbooks that you can use as a SaaS founder. I mean, that is one of the best things about creating a SaaS company, is that, like, it's just, there are so many playbooks for go to market, for marketing, for product development,
It's
that,
becoming very conventionalized. Like 10
yeah.
years ago it was Frontier, 15 years ago, and I think that's well, kind of well stated there.
Mhm.
This is something that we talk with our customers or prospects about all the time. Like one of the key insights with Atrium is that it just turns out that there's a set of metrics that matter, and it's not
Mhm.
to measure like account executives or SDRs or AM CSMs, and it's not like it's not 500, but it's like
Mhm.
a few dozen, right?
Right.
And so just like why not take the conventions on that? Because like reinventing the wheel is like absurd in that regard. Another one of our customers is a company called SaaS Optics. They're now Maxio. People ask me all the time, like, how do you model ARR in Salesforce? And I'm like, you don't. That's ridiculous. You use SaaS Optics to
Right.
do it instead. Like, I think we're in our 4th year with them. But the reason why all these things are like this is because the conventions and the cow paths are there. So like
Mhm.
use that to your advantage rather than trying to, like, I like to say, one innovation at a time, right? Like, you're
Right.
doing enough innovation work on, your product or whatever. Why try to reinvent the wheel on, modeling your ARR or like,
Right.
creating a bunch of dashboards or what have you.
Totally. Completely agree. Don't reinvent the wheel. The stuff when we were doing Yammer like 15 years ago, it's been that long. I mean, it like one of the hardest conversations we had with every prospect was, could they trust the cloud? I mean, it was like literally a tough sell to get people to choose cloud. They all wanted it on-prem. They all wanted us to send them a disk.
This is
So
great. Can you ship me a container? Can you ship me
yeah,
an
no,
appliance?
seriously,
Do an
seriously, that
appliance.
was it. Yeah. So, but since then we've made so much progress. Things are just creating a software company today is so much more like, I guess, routinized. Like there's,
Paint by
you shouldn't,
numbers.
yeah, the only thing you should be inventing is like a really great product, but
Yeah.
everything else, like, you should be using off the shelf stuff for.
Yeah, like really great product, or like really great net new kind of like distribution vectors that
Yes.
maybe haven't been present
Yes.
before. another one of our presentations for the RevEx Summit here is the CEO of Winning by Designs, Dominique Levin, and she was talking about like revenue architecture and how like, good go-to-market can be a source of advantage. I think we were just talking about it earlier, bottom up kind of being like a like a horizontalized version of like appropriate revenue architecture. Yeah,
Right.
we have this like fight with our with some prospects. We're like, it's turning the tide. It's tough when you're like creating a category where 3 years ago, the number of people who are like, you can't measure the success of salespeople. What are you talking about? It resists that. It's all art. We still have some people who are talking about that. Like, what are you talking about? You can't measure, you can't measure the precursors. You can't measure this. It's kind of like in Moneyball, right? It's like all the old scouts, like they kind of like die off and eventually like get shown the door. The last thing I wanted to touch on here is, and you kind of like noted on it earlier, I mean, what's your kind of current outlook on the fundraising environment? It felt like, people and the economy, it felt like, for a second there, people were kind of like getting a little bit more comfortable in the last like couple months or so. And then there was a recent kind of like surprise inflation print that made people think, and then, Jerome Powell kind of like being grumpy in Jackson Hole. And then now the market's like going back the other direction. What's your kind of point of view of the next like quarter or two on that front?
Well, the trajectory is not good. So you're right that the markets are at their lows for the year. It looked like we were bouncing back after June. Previously, June was the low. Now we have a new low in. And it's because, like you said, inflation's not coming down as fast as people had hoped. And in just 2 months between this most recent Fed meeting and the one we had before, they basically raised rates the same. Well, people are expecting that 75 basis points, but the really important thing that changed is that they changed their outlook or their forecast for where they're trying to get rates to, the so-called neutral rate. And they basically raised it from 3.5% to 4.6%. So the forecast changed by over 100 basis points in just 2 months. So the trajectory is bad, and frankly, it's getting worse. And we have extraordinary geopolitical risks going on as well. So I have to say, like, I am fairly pessimistic and bleak about the outlook for the next year or two. And by the way, the recession in the real economy has just begun, or is just beginning. Everything that's been happening so far is in the capital markets, which tend to run ahead of the real economy. So Wall Street's been hit. I think Main Street's about to get hit. You're seeing mortgage rates are almost at 7%. They started the year at like 3%. So the housing market's about to crash. So I tend to think we're going to be in a pretty bad recession next year. I'm pretty bearish right now. A few months ago, I would have said mild recession. Now I'm thinking it could be a serious recession. And again, there's a lot of geopolitical risk out there in terms of what's going on in Europe. So I'm not like super bullish about macroeconomic conditions, and that tends to affect the availability of capital. So if I were a founder right now, I'd be lengthening your runway. I'd be really capital efficient. I'd be really careful about how you spend money, because the fundraising conditions we saw last year, I think that's was an all-time high, and it's already much harder, and I think it could keep getting harder. So I'd be real careful about how you spend your money. And now here's the good news is that in a downturn or recession, actually company building can get easier. The only thing that's harder is fundraising, but everything else gets easier because there's way fewer
purchasers. Yeah.
But I mean, yes. I mean, so it can get tougher to sell if your product doesn't have a strong value prop, but so you do have to worry about that. But building the company gets easier because there's way fewer competitors. Like, your competitors aren't getting funded. New companies aren't getting funded to compete with you if you're the leader in a new category. And it's way easier to recruit and hire. So if you're looking to hire engineers, now all of a sudden it's going to get a lot easier.
Salespeople.
Yeah. I mean, so PayPal was built in the wake of the dot-com crash in early 2000. It was primarily built after that. Yammer which we talked about, was primarily built after the crash in 2008. So both my companies were built in the wake of gigantic,
So what's the next company
crashes.
you're going to start in the the denouement to this crash?
Yeah, good question. Yeah. I mean, I think those days are done, but yeah, I mean, We as a firm, we occasionally incubate something, but it's not going to be me
Oh
running
yeah,
it,
I mean,
which is
like,
the good
yeah,
news.
like, I mean, there's a bunch of things, right? There's Cabal. Like, I feel that
Mhm.
everybody uses Cabal right now for investor CRM management, what have you. Obviously, there's SaaS Grid. I don't know if
Mhm.
Callin counts as a
Yeah.
craft joint, but yes, wonderful. Well, David, thank you so much for taking the time. This is really fun conversation, and I know that our our membership will really appreciate this. For folks out in the modern sales world, our 30,000 members, when you're thinking about capital partners for go-to-market tech, or alternatively you're looking for really sweet go-to-market tech that has a differentiated value proposition, you definitely should check out craft portfolio companies like Atrium or User Gems or Sendosa or Orem, because obviously these guys have excellent taste. So
Yes.
David, thank you for taking the time, and have a great
Yeah.
rest of your day, okay?
All right. Thanks, Pete. Appreciate it.
Hey everyone, thank you Pete and David for that awesome fireside chat to kick things off at our Modern Sales Pros RevEx Day 1. I'm here to announce the next session coming up, Everything's on Fire, Sales Leadership and Rapidly Scaling Sales Org. So stay tuned and we'll see you there.